Hey guys, welcome back to the Multifamily Investor Playbook. I'm Mark Faris, and I'm here with my co-host, John Makarewicz. The mission of the show is to be the ultimate guide for high net worth multifamily investors. And today we're going to talk about why we believe B-class multifamily investments has the strongest case to deliver the most amount of upside potential while balancing the least amount of downside potential in any investment. Now, the problem is there's still many pitfalls that you got to watch out for that could threaten your returns. Now, the good news is today, John and I, we've analyzed thousands of properties throughout our careers, and we're going to be sharing what those pitfalls are. John, great to be here with you today.
Yeah, Mark, so good to be here. And real quick, I wanted to share a little piece of news that just hit that I thought was really cool. So, Greystar is one of the largest apartment developers in the United States, and they recently just delivered an entirely prefab building. And what was amazing is they delivered it at 40% less waste, a third less workforce, and 10% lower cost. And so it's a really interesting development and something I'm excited to see because, as you know, in the US and Canada, supply is a big challenge. So it's neat to see some new technology and some new approaches coming in to help ease some of that burden that a lot of residents are experiencing. But anyway, I just read the article and I thought I'd share a
Yeah.
little bit of that
Well,
tidbit there.
it's an interesting piece there because you see there's a lot of people that are struggling with affordability right now. And so material costs, when you speak with developers, I mean, they're just not going down. So I think that it's fantastic that, overall, we'll just say technology and we'll just say development is actually happening when it comes down to doing things more efficiently. Just like, in the government, right? Sometimes there's lots of ways to cut things down, but when it comes down to building costs, you got to be a little bit more creative. So it'll be
Yeah.
interesting to see how that plays out.
Yeah, it will be. I think the challenge is, the shipping, right? How do you get it from the manufacturing facility to the site? So rail is super important because you take that thing over the road, it gets jostled around. So I don't think we've solved the problem quite yet, but it's just interesting to see. And I like those new creative approaches. But definitely excited to dive into Class B. It is, in our opinion, the best asset class to invest in. And even a C where we take it to a B. So we'll talk through that as well. But exciting topic for today for sure.
Yeah, and John, this is something that coming from the residential field, you buy single family property and you rent it out to one tenant, and in general in the past, it's just everything's worked out fine, unless you run into a bad tenant you don't screen properly. But coming into the multifamily space, we've done a previous podcast on this on your different options, and so when we are looking at this, at this B class asset. We are looking. We want the most amount of upside, so we want appreciation, right? But we want to protect your downside as well, because people ask me all the time, "What do you like, Mark? Do you like cash flow or appreciation?" I'm like, I want both. I want
That's
the
right.
most amount of upside, and I want the least amount of downside. And so, at a super high level, these assets, they are cash flowing from day one. But to get the most amount of upside with the least amount of downside, you got to really be able to cut, what are those downside potential? And we're going to be talking about those today. And then we want that upside as well. And we want the right tenant base, which we're going to be talking about, that B class assets we really cater really well to. And we'll be sharing our secret sauce with you today as well. So definitely you're going to be getting a lot of value from the conversation today.
Yeah, it's we'd like to think about it like the missing middle. Speaking to affordability, a lot of the new buildings, because of all those materials costs and land costs and things we just mentioned, are basically making it to where most new deliveries are these A class buildings that command much higher rents. So being able to provide something, with our renovation program, which we'll dig into, and it feels like a nice new building, but they're able to get it at a value compared to those newer assets. And so it really helps serve that middle class and that working class market that often is challenged to find affordable yet quality housing options. So very exciting.
Yeah, no, 100%. And this is where for us, we just have this like passion to be able to help that middle income tenant base. And so this is the working class, and these are like down to earth, just phenomenal people. The interesting thing that we found is that Most of them that we found that have been in apartment, we'll say rentals all through their we'll say their career since they've been working in their lives. They're living in these apartments, but they just haven't been treated well. It's been more like a number. And so we found that there's the most amount of upside servicing this. You said it was the lost middle. Was it the
Yeah,
lost
missing
middle?
middle,
The
missing
missing
middle.
middle.
Yeah.
And it's so true because we've done a podcast on this on our approach. We'll do that at a very high level on some of the things that we're doing here. But the working class seems to respond extremely well to being treated with like first class service. And a
Yeah.
lot of this stuff, guys, a lot of this stuff, it does not cost anything more. Like for example, a friendly property manager that really has a genuine love of people. This doesn't cost anything more. It costs some, perhaps it costs some upfront work making sure you get the right people. And it's some upfront work laying the groundwork for a strong mission and core values and creating a strong culture. And there's upfront work for that. But the cost to the property is not that, you might offer them a little bit more for the right talent, but it is something that is just not a huge investment. So there's just huge upside in that, as an example.
Yeah, and I think, what comes to mind for me is, years ago at my prior company, Mark Spain Real Estate, we talked about this where a lot of Apple's success, I mean, they're a brilliant company, great products, but arguably Samsung makes a better phone. Typically, they're a few years ahead of Apple in
Oh,
terms of
John,
like
there's a lot of people that'll debate you on that. They're
well,
hardcore
I'm
Apple
an Apple
guys.
guy for sure, but it's funny, like I just got this new feature on my new iPhone that you can like edit out things using AI or whatever. And like Samsung's had that for like 3 years. But I mention it because what they did was they provided a product that felt very luxurious to everybody, right? And so the way you open up that box, that vacuum seal, it's substantial packaging, like that was all very thoughtful. And it just goes back to the cost to do that versus maybe a cheaper box was a few extra dollars, but they're selling $1,200 phones, and people are renewing those every year or two, right? And so I think about that because it is that idea that if you can provide what feels like luxurious service to all people, they're going to come flocking to you, right? And I think that's what our approach looks like, where our offices are open 6 days a week. We handle maintenance requests quickly. We treat everybody with dignity, and we treat everybody fairly and equitably. And it's why we're able to get the renewals we get at the rates we're able to get, because we're providing that feeling that is often, to your point, missing, right? Or the operators just simply don't care. It's all about the bottom line. So,
Well, and this is what we're seeing, John, with John and I, with our background in business. One of the things we look for is where's the growing customer base, and the working class that is growing. So there's more and more people that are in that middle class, and actually getting into more affordable apartments is a growing. There's growing demand there. Okay, there's less people that can afford $3,000 monthly rents, $2,500 monthly rents. There's less people that can afford that. And so not only when we buy in these affordable areas that, the working class flock to, because it attracts employment and jobs and people, but what it also attracts is that they understand that they can pay less rent. They can pay 1,600 to say 2,000 or 2,100, and there's more people that are growing in that segment, in that demographic segment there, an affordability segment. And so this is something that we want to cater to a growing market. And so for us, this is where we've kind of put a stake in the ground and say, hey, this is where we really want to go all in at. And like John, maybe want to share like some of the examples of what we're seeing when it's coming to our projected rents with, our buildings.
yeah, I mean, I think, really, if you look at all of the deals we've acquired in 2024, we're outperforming our projections, and we do underwrite very conservatively. If the smart money says organic rent growth will be 3%, we pull it back a little bit, right? We want to make sure that we over deliver for our investors, and so that conservative approach is baked in, but we are blowing our projections out of the water. And if you look at it, what it often is boiling down to is just the right people, the culture, all those things you mentioned. We just got a review in on one of our assets today where the person's just like, it finally feels like I have a home, and it was their first place they've ever rented and, on their own. They've been with roommates prior. And it just goes back to, for example, in Florida, typically you might have a Spanish speaking population. So ensuring you have somebody that's fluent in Spanish is super important. Making sure, once again, the sales centers are open. Gosh, if you have a, leaky faucet, or your toilet's clogged, or your dishwasher's broken, that has an impact on your life. And if it takes 3 weeks to get it fixed, I mean, that's significantly impacted your situation. And so, just being mindful that these are, people, and they have other things to worry about, and they shouldn't have to be worried about whether we're going to take good care of them or not. It should be kind of a non, it's like table stakes, right? It's just baked in. But yeah, I think, that strong demand for the working class and providing that feeling of luxury and service. It's like the idea that, Holiday Inn and Ritz-Carlton both exist, right, in the same world. But why is Ritz-Carlton able to command the rent they command? Yeah, the beds are nicer, and the buildings are a little bit nicer, but it's the service that people go back for time and again, right? And so that's what it's all about for us.
Yeah, and that intentionality that we take into it from the beginning is like when we take an asset over that first 28 days is critical because everybody's watching. All the residents are watching. It's like, oh, here comes another ownership group. We'll see what they do this time. All promises. And for us, it's like we before we say we're going to do anything, we do it first, and then we host an event at the end of that rollout. So it's like we say, look what we've done versus what we're going to do, and that's been huge. And so to kind of wrap up that point there, when you treat a B class resident, so everybody's everybody's equal, right? But a resident that's living in a B class building, when you treat them with first class service, you can get outsized returns because it's so rare because they just haven't seen it before, and it makes more of an impact than if you do first class service on an A building or a brand new building where people are paying higher rent, so that's what they expect. And because it's so rare, it makes more of an impact and it creates more buzz, which keeps our buildings more full with premium rents, which give higher returns to our to our investors. And you can see how it comes back full circle, but it starts with a mindset, and ultimately it's a culture that needs to be implemented from day one, not halfway through the whole period, 2 years down the road.
That's right. And, the B asset class for us is so exciting because of that value add potential, right? So, not only do you, first things first, you take care of the service, and you show up on day one, attack the property in that first 28 days, the exterior renovations, amenities, refresh, rebranding, et cetera. You know, it's interesting to me too how just the monument signage, I think that's something a lot of operators miss. I've driven by some properties and it looks like, they literally got some cardboard and, painted a sign on it, and, just very flimsy and just cheap looking. And, when somebody drives up, it's like that thing when you and I both started our careers in residential real estate. Like, I could tell somebody was going to buy the house when you rounded the corner and they see it for the first time. I mean, often even before you pull into the driveway. And so landscaping, a very substantial uplit monument sign, clearly displayed from the road. We put some flags up with the state U.S. flag and, our property Faris residences flag. And it just sets the tone, right? And so being able to then go in and renovate these units to provide, all the amenities of a unit that someone would get with Class A, so whether that's granite countertops, all new fixtures, all new appliances, new flooring, fresh coat of paint, our signature scent, right? Model units. It just sets that stage. So when somebody comes in, it's for me, it's the idea like we have to get them on that first tour, because otherwise they're going to go down the street and get signed at the next property. So if you don't make that really great first impression and then back it up with an exceptional unit and an exceptional property, you're going to lose that business. And so that value add potential, which I'd love for you to hear more thoughts from you on, is why we love that, because we're not just relying on appreciation, right? Some of those Class A buildings could be great investments, but it's a more conservative. You're really focusing on the cash flow. You'll get some appreciation, but we can come in and force appreciation through renovations, right?
Yeah, you nailed that. And if you're for those of you that are listening and you heard that in regards to buying a property. So when we were showing buyers we could see it in their eyes as soon as you came around the corner, like you said, John. And it was like you knew it was the right one, and they knew it was the right one, and it got a little quiet in the car, right? It's like all of a sudden they're like, "Ooh," all right. And if you're listening and like, if you go back to your first property, or maybe your past property that you purchased, and you think about it, there's accuracy in what we're saying, that that first impression is so key. And so it would make sense that if it's the same for a residential it would be the same for a multifamily investment that somebody's going to rent their home, right? And I think, John, that's something that's overlooked. I'd say not so much in the A class, but it's overlooked more so in the B class, because these buildings are, it's between 1980 and say 2010. So they're a little bit older, and it's kind of like, well, it's an older property. We don't really need to, keep it tight and make that wow first impression when people drive up. But if you do that, again, that's what gives you outsized returns, because a lot of the other asset classes are not paying that kind of attention to detail. And I think with our background as well, John, that actually pulls into not only the exterior, so that wow factor with starting with the monument sign, which is we've spent a lot of time getting that right for us.
Yeah.
Backlit, making sure it pops, and even the name. I mean, the amount of time that we spent into Faris residences, making sure it's the right name, and that it's consistent branding. Like, it's just crazy amount of time that we put into that.
Yeah.
But that sets the tone right off the bat. But when people walk into the leasing center, even that the leasing center is stage, and then going into the model suite as well, that stage. And John, that was like, actually, as I was getting more into multifamily a number of years back, that was probably one of the biggest, we'll just say, surprises that were out there, that you have a model suite, you have a leasing center, and either they're not staged at all, you got like, papers everywhere and things that are messy, or the property manager was staging it kind of whatever was actually there. And we're talking about tens of millions of dollars, and you have potential residents walking in, but there's no sort of like wow emotional pull where they can say, "Oh, this feels good." And it's the same approach if they're looking to lease or they're looking to buy. The reality is they're both selecting their home. So the emotional side of it is so important that you get that right. And that's where with B class, there's more of an opportunity to be able to differentiate yourself by doing a great job.
Yeah, that standout for sure. The Ferris residences, part you mentioned there. One thing I like about that is it's you literally put your name on it, right? And so when you do that, you act a little bit differently, I think, right? Because
Yeah.
ultimately, my previous business, the founder, Mark Spain, name was on the business. So, like he took it personally if an agent, generated a bad review, because they're saying Mark Ferris, or I'm sorry, Mark Spain isn't good, right? And so, it just forces you to put a lot more pressure on the property management team, that, us, the team here at Ferris Capital Partners, to make sure we're delivering. And that was very intentional, right? But the forced appreciation component, that ability to, really drive additional net operating income through renovations is really the magic here. And, I'd love to hear, kind of some of your perspectives on that.
Yeah, for sure. Just before that, like, I got some pushback on naming the company, Ferris Capital, because, and Ferris Residence is the building, because there's a lot of owners that will, have a separate name, and that is still good. I'm not saying that's not good.
Right.
That's definitely still positive, but they're like, people are going to know who owns it. What happens, if you don't do a good job, or somebody gets mad. And it's like, well, listen, that's like, I call that a catalytic mechanism. It's like
Yeah.
that forces you to make sure you don't rip anybody off. You do a great job. And so, yeah, it was intentional. I put a lot of thought into making it happen, but there was just that much more pressure making sure that we got the team right. I know when you and I were building this, like, we put painstaking care into making sure that not only all the team members, from our asset manager to, finance to acquisitions, and, all the rest of it, and, frontline property managers and leasing, that everybody is our brand, but, ultimately that we're looking at the details. Now, to answer your question with the value add, John, this is one of the big reasons why I fell in love with multifamilies, because, with the formula of the income formula when it comes down to the income approach for multifamily, it's basically all a factor of how much you can go in and increase net operating income. How can you go into an actual building and look, how can you actually generate either more income or decrease the expenses? And with B class, there's more opportunity as a property gets older to come in and add new things or
Mhm.
to improve certain things. Like, for example, if you buy a brand new building and it's only 3 years old, the kitchens are still they're still in good shape, right? Flooring's still in good shape. Maybe they had stone countertops, but when you're starting to get older than 2010, especially when you're getting into the 80s, there's a lot of cases where maybe it was even renovated once, but it's like super dated. And so when you go in and you do a facelift, and for us, we're doing renovations per unit in that $12,000 to $14,000 range, where we're doing stone countertops, we're opening the kitchens up, new kitchen cabinets or new face, and we're doing new flooring and new lighting, new fixtures on the doors and hardware and new bathrooms. And we're basically we're going in and people are seeing the value, and we can get $150 extra per month. And we know for every dollar that we increase the net operating income per month, then we know that we're increasing the value of the building by $240. And so that's where with B class, we found that there's more opportunity to do that. And once you spill over into C class, you get older, there's downside potential where you're getting into, there's a building code change in around 1980. And what ended up happening was they made buildings more efficient. There was less problems with plumbing, galvanized plumbing and
Mhm.
electrical. And so by staying in 1980 and newer, you're getting a lot of upside potential, but you're not getting into we'll just say, the more expensive items that can come up in a building.
And the reality of those types of repairs is they don't add value. So if you have to replace the plumbing system or the electrical system, you're not driving any net operating income. You're just increasing your expenses. So, when we look for these deals, we often want to see newer roofs, even, right? Because roofs have to be replaced on a timeline. But, if we have to take that on, then that's just an expense. And so that actually pulls down the value. So, going pre-1980s, I mean, gosh, asbestos, lead-based paint, the galvanized plumbing, and all those things you mentioned, it's just we avoid it because for those reasons, right? All it would be is a negative impact on the value of the building, and plus, for us, it's largely a safety concern as well. Some of these older buildings have a faulty electrical system, and your fire breaks out. I mean, God forbid, and it's too much risk, and so that B class, to your point, is just that perfect balance of risk and reward.
Yeah. And John, this isn't just from our own experience. Like you and I, we spend hundreds of thousands of dollars getting the right advisors, right? And building the right team around us to get wise counsel, right? But, this is from a lot of the networking we've had with other top groups that have billions of dollars worth of real estate. There's like a consistent theme. So we don't only take our own lessons learned, we mastermind with other top operators and we pull all that data in and then we make wise decisions. And John, that's like one of our core values, right? Making wise decisions. Actually, John, you want to just tell the listeners here, we have these 5 core values. Why don't you just tell them, what the 5 core values are and kind of what are they before we move on here?
For sure. So first, a genuine love of people. So that's where it starts. That genuine love of people, make wise choices, as you just mentioned. Then we go down to first class service, then to operational excellence, and then speed of execution. Now, those are in a very specific order. So we filter our decisions through that lens in that order. So, for example, we wouldn't sacrifice service for speed, or we wouldn't sacrifice operational excellence for speed, right? So, this is a business and it is a capitalist enterprise, right? So when we talk about a genuine love of people, it's how we treat them. But we're not going in this as charity, right? So, helping people out when they're in need, but taking care of those residents that are a bad fit for the community. And by that, I mean non-renewing, or if, they're a real problem, maybe lease violations. But those values are so critical. And we even take it a step further and we've defined what we call the fundamentals, which are like the 35 behaviors that, like, make up those values. So things like, picking up the phone when there's a conflict, in other words, don't text message or, have a conflict situation over email. All those things that we talk about on a daily basis in our huddles, create an experience for our investors. So we don't just have the values, we actually define those values with specific behaviors. And every day in our morning huddle, we review one of those 35 behaviors. And it's, now 2 years in, and we just keep going through it, every time we start. And so that consistent, constant reminder to the team about what's important to us, just reinforces that culture and that, sort of operational excellence.
Yeah, well said. And if we think of the amount, like the core values are and the fundamentals are like the base or the foundation of the company. And so our mission is to go full out for our investors. This is on the investing side, and to provide the best investing experience in the world. Now, on the resident side, it's to go full out for residents to provide the best living experience in the world. And so that's like the mission that gets us to the top. And so it's all based around this experience mindset. And so for us, where we're going is we want to be able to help 10,000 residents have the best living experience in the world. And so the B class, this is where we really have like a heart, and we see that there's a strong demand for best living experience for this asset class. Now, here's the interesting thing to kind of move this along here is that in economic downturns, okay, A-class tenants may downgrade and generally do to B-class because they can't afford their $2,500 to $3,000 a month rent anymore, right? So in an economic downturn, it's actually safer to be in the B-class space. Okay, it's safer to be in the B-class space. And so the demand actually increases because residents, they want stone countertops. They want to still have their friend, I moved in, it's got beautiful stone countertops, right? It's got, beautiful, vinyl plank flooring here. It's all neutral, right? And so, and the property management, they're treating us really well. They want to be treated well, but they don't have that upper end budget for that.
Mhm.
So it's a very, very resilient asset class to be able to invest in.
Yeah. In fact, just some recent data on 2024. I was studying, CoStar and RealPage, two different multifamily data sources, kind of released their year-end reports, and it was interesting. Actually, C-class buildings had the most negative lease trade out. It's called the flight to quality. People are renting longer. On previous podcasts, I mentioned, that the average home buyer in the United States, first-time home buyer, should say, is now 38 years old. Used to be closer to 30. And so people are staying in there longer, and so they're looking for that quality. And so it's another reason we love B. It's a value compared to A, but it's nicer quality than that C. And you're having now more families where both spouses are working, and so they're trading up to those nicer units, but it's that perfect affordability. So even in this challenging market that we're in, C actually suffered more so than even A, but B was right there where, for example, if we were to look at Tampa, and you just look at the whole city of Tampa, really the whole metro area, they had about a negative 1.5% lease trade out, but we're getting like 5 and 6 and sometimes 8% plus organic rent growth. And when I say organic rent growth for the listener, what we're talking about is just a renewal. So in other words, we didn't renovate or touch anything. We just renewed them. And so we're getting those premiums because of all the things we just discussed, but it also just speaks to it's still of better value than going up to that 2,400. And so great example, Charleston. The in-place rent average for the 2-bedroom, 2-bath units when we bought the property was around $1,250. There were some tenants that had been in there for a long time, and they weren't as aggressive with their renewals. They were achieving around $1,400 on some of the newer leases. We get in there, do our renovation program. We're now getting $1,850 a month, and we're pushing up towards 19. Even on classic units for renewals, we've been getting more aggressive with our rent lifts because the residents feel the value we're providing. And, so within less than really about 6 to 9 months, we've just completely transformed the net operating income on that building, and we're just getting started. So, Yeah, people are looking for the quality, but they also are watching their, pocketbook, right? And making sure they're not
Yeah.
putting too much money out the door. And so for us, if we're looking at a particular deal, we want to see no more than, I mean, in a perfect world, it should be less than 30% of their income should be going
Yeah.
to rent. So we're looking at a deal right now in Jacksonville where it's coming at about 27%. So we look at the average income in the 1 mile and 3 mile radius of the building. And if you're like 35, 37%, that's a deal we're not going to do. So we're very mindful too of just watching what's happening in that area and making sure we're fitting into that affordability.
Mm,
And when we're talking about that 30% rent to income, we're actually talking about post renovation. So it's one of those critical factors we make sure to
mhm.
underwrite into all of our deals. So we know that the community can afford what we're about to offer. So you have to look at the comps and all the competition in the area, but you just also have to look at the demographics and what they can afford, right? And so that's another reason we love
Yeah.
B. We're providing that affordable but yet, attractive option.
Yeah, well said, John. And so when John's talking about that rent to income ratio, it's just take for example, the average income is $100,000 in an area. In a ideal world, we want the average rent per year to be $30,000, right? If it gets up towards above 35,000, we do not. That's not something that we're really attracted to, unless there's like a really strong case for it. But that's like a red flag for us. And so John had mentioned this asset, the average income after we renovate. This is after we bumped it up. It's 28,000 if it's a $100,000 income in that area. And so just to give you context there, it's very affordable. And John, like up north of Toronto, like Toronto is at 60% of the average income to rent ratio, and like New York is 70%. And so this is why, like, going back to the markets is so important. But with B class, it's easier to hit the rent to income ratio that we're really like. And the reason why that's so important is that there's more upside to push rents because people have more money in their pocket that can afford higher rents and to, push above what we project and to over
Yeah.
deliver on our returns.
And it's, the trickle down effect is they have more money to spend, right? And to support the local economy, which then in
Right.
turn creates more jobs and more business. And, so those high cost places, when I was like 20, I thought it might be neat to live in New York. Now I like a weekend and I'm like, okay, I'm ready to go back to somewhere normal. But, for me, it's really, I think why it's just worth mentioning that, we that genuine love of people is top of mind, and so, we wanna take care of the residents, and when we ask for more rent, they're getting that value, so it's not even a question for them, they get it. They're like, "This makes sense because the building is so much nicer, my unit is so much nicer than what I had prior."
100%. Yeah, you nailed it. It's not like they're like, oh, my rent's going up here. I don't see any value. It's like we just did, A, B, C, D, and they see it first. So it's the whole rule of reciprocity. So moving on here, John. So the downsides of B class. I mean, there aren't a lot, but I'll maybe start with the first one. Is that B class assets are extremely rare. That's one of the downsides. We have to look through 200 different opportunities that are available for us to purchase. We have 200 of them coming through. And so our acquisition specialist, Joe, we'll have him on at some point, and John and I will talk with him. But Joe is like every single day, and I know John, you're right there with him on a daily basis, and we're looking at deals. It's sometimes three or four or five, and it's just like, what? Nope, no, 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 no. Just imagine going through 200. So unless you're like full time, and it's like we're more than full time going at this. They're just so hard to find. They're like a needle in a haystack. So that's one of the downsides.
Yeah. So, we're recording this episode, somewhere in mid-January of 2025, come out a little bit later is why I referenced that. And in that time period, we've received approximately 30 potential deals. And about 85% of those are Class A new construction. So the developer's leased up, and then that's typically what happens. The developer builds the building, they'll get it leased up to about 60, 70%. Then they trade it to an operator who will take it over for, maybe say the next 5 to 7 years. But if you look at that number, the amount of deals we got, that 30, there's like 4 that were possibilities and really only 2 that we're kind of excited about. And so it just speaks to that. And the other component why they're so rare is because we're not the only ones who love B class, right? And so there's a lot of competition for these assets. Other operators like this space as well. And so, for us, it's about those broker relationships that we really work hard at to build. Provide feedback on every one of those deals we got, even the ones that we're not even going to like, it's not even in our buy box. It might not even be in our market, but we're going to thank them for sending it and give some feedback. And just a lot of other things. We'll do a whole episode on that as well. But, you have to win the deals by standing out, and brokers want to know who's easy to work with and who can close. And so those are important factors. And then it's also in the terms, right? So we get, if we like a deal, we have to get aggressive, hard earnest money. So I also think it's worth noting that Mark and I personally invest in these deals. So, we believe in them in a big, big way, and we're putting our own dollars on the line right beside our investors.
Yeah. And so just to give you context, what hard earnest money is that, these assets, when we go in, we submit a letter of intent, so an LOI. And then generally that could take like a week to 2 weeks for our attorneys or lawyers in Canada, we would say. And it would be, 1 to 2 weeks to get the agreement drafted. Okay. So once that happens, we need to submit a deposit or hard earnest money in a lot of cases. And, like the deposits or earnest money are, can be anywhere, 1 to 2%. But when you're buying, like, say, we're looking at a deal right now, it's, $30+ million, right? You're at 300 grand, right to 600 grand. And right. And so part of that as well is, sometimes the seller wants hard money, which means that once we go in, we say do our due diligence, or sometimes even before we do our due diligence, they're saying, we want to know that you're serious. And that means if we don't close on the asset, then we lose it. So that we're talking about like $500,000, in some cases higher than that, where we're coming out of pocket. Okay, this is like out of our pocket, and we got to make sure to do our due diligence up front, be extremely conservative on our underwriting, right? And then make sure that we get it right off the get-go, or else we're gonna lose something. So that's where hard earnest money is something that is a huge competitive advantage, but it comes with its risk, which means that we need the right team, and we have the right team to be able to do that. But just for context there, that's what that means.
And so another con, Mark, with these class deals, it's just like operational complexity. So, how you need to think about this as an investor is basically what we do is we're a business that buys another business, right? These properties are businesses. That's all it is, right? So it's operational efficiency, increasing profit, increasing NOI, reducing expenses. Candidly, reducing expenses is challenging in today's market. Things aren't getting cheaper. We just had record inflation, right? Insurance costs are going up. I mean, look what just happened in California with the wildfires. I mean, it's a market we wouldn't buy in for those reasons, but it's just there's so much risk now that is putting pressure on those expenses. And so with that, we're operating this business, but when you buy a B class asset, we're managing the building, but we're also managing a construction team. And, we're making sure that these units are being turned and they're being delivered on time and on or below budget. And so it's complex. It's not just, we bought the building and just wait for the rent check to come in. So we're managing a team of people operating the building. We're managing the construction teams. We're working with the third party property management team to hold them accountable to our results. And then we're managing our team and our expectations around these deals. So, for a novice operator or for a single, kind of person, it's very complex, and that's one of the challenges. And it's why we had to spend so much time, optimizing our team and building a strong culture before we even thought about doing our first deal.
Yeah, well said. The next one is potential, and this is a big potential here, is that compared to, say, like the inner city, the hottest city block, that's A class, that is prime real estate, that's like right on a busy, super sought after corner in the city, right? That a building that is there could, and in history, could appreciate faster than, say, a B class building in a B class area. So B class area, maybe it's more, a little bit more suburban, so garden style. So we're looking at an asset right now, it's 200 140 units and it's sitting on 20 acres, right? So it's not right in the city, but it's just outside. So that may not appreciate as much as like that hot corner, that A class asset that's newly built, right? So that is another thing that there's still appreciation, but it may not just be as much as that hot spot as well.
Yeah. Another one you have to be mindful of is just the risks in doing renovation, right? Because materials costs could go up if you're not closely monitoring the process. We actually just recently heard a story of an operator who pre-purchased materials, and then they go and do a audit and realize the contractor was stealing stuff, right? And so we don't do that, but there's a lot of risk. So it's like like a micromanaging type approach when it comes to working with contractors, right? And so that is some of the risk with value add, unless you have that strong team and that strong eye on the details. So one way that we like to mitigate some of that risk is we always bake in a 10% contingency budget. So if we look at our total capex and say it's $1 million, we're going to budget 1.1 million, just to ensure that if there are any cost overruns, we have the capital to complete. And then when we underwrite, we don't like unnecessarily increase the budget, but like if we think it's going to be 100,000 in landscaping, we might budget 120, even just there, separate from the contingency, just because you don't always know. And then to take it a step further, because we have great relationships and we have an in-house construction manager, we're getting really hard quotes before we submit that LOI, and that all actually extends all the way down to insurance and factors like that. We don't wait to see what happens once we go under contract. Our insurance broker is phenomenal, and he gives us really good numbers, and you can essentially take them to the bank, so to speak, in terms of what your actual insurance quote will look like. So, those risks, right? If you're not really tight with your due diligence and you're not looking around every corner, you may have some unexpected expenses. And candidly, our Largo deal, I think I mentioned it before, but the irrigation system wasn't working, and we were told it was a product of the system, but turns out the well had run dry, so we had to dig a new well. But because we had that contingency budget and because we came under budget on other line items, it didn't actually cost us anything above what we had projected. So it's just that risk of, you just never know, and sometimes you open up a wall and find things you didn't expect to find. So really, really detailed due diligence is critical here, and you can't skip any steps.
Well, and John, that's where what we're finding is in most cases on each line item, it's like we're oh, we got extra there. Oh, I was able to save there, and I think that's like one of George's standard answers, like, oh, I was able to save here, here, and here, and it's like, oh, okay, well, we got more than enough for that, and that is just so rare because in general you go after a project and you basically you project out, but in most cases it's always over. But when we're dealing with hundreds of units, we can't be over. And so this is the power of having a strong team, being able to peel back after. And that's why when we make our LOI, we're extra conservative where we can peel back.
Yeah.
You know, John, that the example there, like with the GC, I think that's just something to really underline. With value add, you have not you. I'm just going to say, in general, getting a general contractor is critically important. They're like your partner in this. And so, the example, John, like we're looking at a deal right now and they went down. Why don't you tell the story of the lease down that they were able to like bring it down, and their vacancy went to like, past 35%, and they got into a dispute with their GC. Why don't you share? I mean, this is real life. This is happening right now.
100%. Yeah. So in this case, I don't know the operator, personally, and we haven't dealt with them before, but they took an unusual approach, and so they wanted to renovate 100% of the units. So they actually dropped vacancy, or they increased vacancy on purpose. So what they did is they non-renewed people. And so they started the renovation program very aggressively, but they got into dispute with the contractor. Construction stopped, and they found themselves at 58% occupancy. And so then the lender's knocking on their door going, guys, like, if you don't get your act together real quick, we're going to foreclose on you. So then what they did is they jammed the, property, beds, heads in beds, and just started just slashing rents and giving concessions. And so that challenge for that operator has become our opportunity. And so, it just goes back to, that contractor, dropped the ball on numerous things, was overspending and, it sounds like was even stealing materials, as I mentioned. And so for us, like going back to the critical factor there with the general contractor, like our guy, Dom, is exceptional. And at one of our properties, we were going to put like the nice, clean white tile backsplash in, kind of that subway look, that subway tile. And he comes to us, and he says, and by the way, we didn't, I mean, look, we're always saying save on cost where you can. But he said, look, there's this new product. It's actually a PVC plastic. And I think you and I were like, I don't think so, Dom. He's like, let me just put it
Yeah.
up here and I'll show you.
Yeah.
And I guarantee you, you could look at one with the tile and one with the PVC
Yeah.
and you couldn't tell the difference. And it saved hundreds of dollars a unit. And so we're delivering those units at lower than we projected, but it's about getting creative. And so when you align yourself with people that just care, he's not doing it just for a paycheck. He does it because he loves it, right? And you find somebody like that, and they're looking for ways to help you save. And those people are very rare, man. A lot of people
Yeah, they
just,
are.
like, whatever, they log in or whatever, or they punch the time clock, and then at 5:30 they punch the time clock and they're done. This is a guy who, if we said, because we've done it before, we said, hey, can you drive to Jacksonville? He lives in Tampa
Yeah.
on Saturday to scope out this property because we got a tight timeline. He's like, yes,
Yeah. I'm
and
gone.
so
I'm gone.
yeah.
I'm driving already.
Yeah, he's already on the road. So, it's about that,
Yeah.
that ability to find that kind of talent and foster strong relationships
Yeah.
and get that buy-in to the mission, that full out experience that we're promising not only our investors but the residents, that leads to these exceptional results. So, just goes back to, it's very complex. So without the right team, the whole thing could explode.
Yeah, no, well said. Definitely important. And the as the years go by, becomes more and more important of the right team that's executing on that, and also the right engagement as well. I call it like this urgent attention to things, right? Urgent attention. And so you can know what needs to be done, but unless you have an urgent attention to it and you actually take action on it very quickly, then things can start to slip. And so that's one of the downfalls that I see. B class is no different. Is that, oh, the property manager is looking after it and they got it, and oh, it's looking after itself. But the reality is, these larger assets, you have to, like, it's in urgent attention. And so what you do is you set the tone. Just like in any business, the leader sets the tone of what is to be expected, right? And unless you set that tone from the top, property managers will just kind of, fall into mediocrity. And so it's so important that you set the tone. This is what is expected. And so that's why, we're on site fairly regularly as well. But, there's an ongoing call, Zoom call, that happens at minimum once a week, if not faster. But we're reporting on an actually daily basis in many cases that this is happening. And so it becomes very important, urgent attention.
That's it. Yeah, and that kind of brings us to I would say the last, potential downside risk to be is just they are management intensive. We kind of touched on, managing the landscaping crews, the contractors and all that. But poor management can quickly just erode your returns, right? And we actually had an unfortunate situation at one of our assets, and the person was actually taking some money orders and cashing them. And it was the dumbest crime in history because we caught it very quickly. I mean, within a couple of weeks. And, we made the residents whole, and, it all worked out, and the bond covered the lost income there. But that was somebody we inherited from the prior property manager. And, at the end of the day, like, the decision was made at that moment. We never except the person that's on site, we go out and hire. Now, that person may be in the running for that position, but they're going to be amongst other candidates. So, we're all about sharing the wins and the challenges and the, successes and the problems. And that was a good example where, we thought we had the right person because they had done a good job prior. But, the learning lesson is, we got to treat these people like we just met them, and it's like a full hiring process that we run. So that management intensity is something that, with somebody like Georgia Patron, who's our senior vice president of asset management, she does it with love, but they feel the pressure. Let's just put it that way.
Yeah,
And I would say
yeah,
just to add to that, one thing
yeah.
that we do that I think is a little unique, is Mark and I see every single review that comes in at the resident level. So if it's a Google review or apartments.com review, they come straight to us and we personally respond to them. Now, fortunately, we've only gotten 4 and 5-star reviews, actually largely 5-star reviews since we've taken over these deals. We actually haven't gotten one negative review at any of our assets, but it could happen. But the point is we celebrate that. And if we see a bad review, they're going to know we're seeing that too. And we're going to be reaching out and saying, hey, what happened here? What are we going to do about this? How are we going to make this right? And so I think when they see that, then the pressure, it's not even really pressure. It's just they know we're watching and they want to perform well because we hired the right person. So these are just little tidbits we've learned that make a big difference to the bottom line and to our investors' returns.
Yeah, well said. To kind of wrap up your last thought on Georgia about giving love, sometimes she's very good at giving tough love,
Yeah, oh, yeah. 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 You
which
don't
is
want to
like
disappoint
we all
Georgia,
we all need it sometimes, right? But definitely she's
including the
able
you
to
and
give
I,
tough.
right?
Yeah, no, and we're a culture of truth, and the mission is above all of us, and I think that's like so important that team members can feel uh, safe to speak truth no matter who you are.
That's
Uh,
right.
Final thought on when you were talking about like you were talking about the intensity of or the intensive care that these properties need. It really is a full-time job to manage. And so the last example we'll give is we bought an asset and there were a couple of doctors that own. And so, John, you want to wrap up with that example where they realize that, oh, geez, this isn't what I thought, these larger multifamily properties.
So, there was a period of time, certainly like 2020, 2021. I mean, really kind of towards the back half of 2020, once, certainly the pandemic was still raging. And obviously in places like Canada, I mean, it was very real. Lockdowns were still happening. But around the US, particularly in red states, the restrictions had loosened up and real estate market exploded. And so we saw these huge returns and a lot of people started diving in. And in this particular situation, these two guys had other full-time jobs. I mean, they were like, doctors, right? And bottom line is the market started to take a dip, and they didn't have the operational efficiency. They weren't keeping tight controls on the property management side of things, and so the deal started to not look good. And what happened is one of their deals had a major issue with an electrical system. It was actually a '70s asset, and they didn't budget for a $1.2 million repair that ended up falling in their lap. So by the time it was all said and done, apparently the two partners like they no longer speak to each other, and the whole thing exploded. And so that time intensity is something where as an investor, you need to have like a really a direct conversation with the operator and make sure they're not working some other job. Because this is not a side hustle. This is beyond full time. I mean, Mark, you and I mean, we're talking on weekends and nights and emailing each other back and forth. I mean, the whole team. And if something comes up on a Sunday at one of your units, you got to fix it on Sunday because that's our guarantee. We have a speedy response guarantee for all repair requests. So, it just goes back to this is where people live, and we need to make sure that they feel that we understand that, and we don't take our responsibility to provide them an exceptional experience lightly.
Yeah, well said. To tie everything together, guys, here's some key takeaways. So, based on our experience and based on our conversations with the best out there that we've seen, is that B class assets provide the most amount of upside with the least amount of downside and ultimately higher returns. And the second part here is that the operational team is critical to a multifamily investment success. Okay. It's so imperative. We spoke a lot about that today, and it's not something to be missed. Okay. It's not just something you just clock in and clock out, it is more than full time. And last but not least, treating a B class resident like an A class resident. So that first class service will deliver outsized returns. So, on that note, guys, thanks for listening. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.